Hey everybody, welcome back to Capital Consumption Theory. And today we're doing an episode on the meme economy, GameStop, Dogecoin,
Doge.
cryptocurrencies, all of this. Zach, I'm Eddie Chu, and we're here with Brian Winters and Zach Widmer. And Zach had some ideas about this topic. So
Okay, I'll take over from here. Eddie, you've said a couple of times that when it comes to capital consumption theory, we have capital and it's trying to find a good investment to invest into, and it can't. And so it flies around and inflates things randomly, like meme stocks and meme cryptocurrency.
yeah,
But one
yeah,
thing that I've been kind of noticing is that a lot of the people who are investing in these things are not necessarily the people at the top of the economy who are looking for investments. They're people more in the bottom of the economy who,
yeah.
in my feeling, have kind of lost faith in the real economy and are instead looking for something to make them rich because they don't think the real economy will actually lead to a good life for them.
Absolutely.
What do you think about that?
So there's one thing that I think we have to disabuse ourselves of the notion of. So one thing that is very common, like in finance circles and in financial news, is to talk about sort of money going into one investment and causing the price to go up, or out of a certain investment and causing the price to crash or something like that. And the more, I've been paying a lot of attention to these topics as well. And the more I think about it, the more I think this is one really key insight that you have to realize. So it's not actually true that money or capital can go into or out of most financial investments. So including cryptocurrency, for the most part, stocks, things like this. If you think about it, um, for every person who buys the stock, somebody else has to sell the stock, right? So at the same time that money is going into the stock, it's also coming out of the stock. So in other words, there's actually, it's sort of not really an inflow or an outflow. Um, People talk about inflows and outflows, and there's certain like measurements that you can take, but fundamentally, there's no inflow or outflow. It is just people who own the asset, people who don't own the asset, and two of them are pairing off and saying, okay, I'll sell, and the other guy says, okay, I'll buy, at a particular price. So of course, this goes back to the very fundamental ideas in economics about supply and demand, supply and demand. So everybody knows that when you have more demand, then that drives the price up. But you have to be very careful here that there are two variables that you're talking about. One is the quantity, and the other is the price. There's two variables here, and they're not they are not. You got to be careful not to mix them up. So when GameStop is going like up to, it's been up to $400 now. Last time it peaked, and it's turning up. It was turning up these last 2 days, so I think it's up to 200 something again. And it's looking like there might be a chance that maybe it goes crazy again. um, you know, there's that might happen, and that would be interesting to see. So the question is, what is going on here? Um, and fundamentally, it is not necessarily about money moving in. Um, if you're a trader, and you look at sort of financial market prices, you have a chart of the price, and then at the bottom you have this little chart of like sort of spikes that go up and down, and that is the volume. So the volume can be up or down, even as the price goes up or down. And a large volume just means that a lot of agreements are being reached. On the one hand, a lot of people are selling. On the other hand, a lot of people are buying, right? Both are elevated. So that might mean something to traders, but at the very root, um, you don't need money going in for the price to go up. All you need really is for the buyers and the sellers to be, to be sort of raising their target price. It is fundamentally a psychological thing. So you can take an analogy. Imagine like Zach, you and me, we're like, thinking about doing a trade. So I've got a share of GameStop and you want a share of GameStop and I'm thinking about selling it and you're thinking about buying it. So a lot of people kind of make the mistake of thinking that, oh, this is like Zach's demand, like Zach is rushing in to grab the stock and it's going up. But it's not a volume thing necessarily. Like you and I we're either going to have a volume of one, we're going to trade it and generate a volume of one, or we're not going to trade it and we have a volume of zero. And there's a lot of things that can happen. So say we're both, watching the TV, the news, or there's a third person here like telling us stuff, and some news comes in like, oh, Elon Musk is going to acquire GameStop for $10 trillion or something. You and me, regardless of whether we make the trade or don't make the trade, both of us are going to have like this. The price in our head is going to skyrocket on that news. Like I'm going to think, I'm the seller, you're the buyer. I'm going to think, wow, this share is worth a lot. I'm not going to let it go for unless he pays me like, $1,000 for it, uh, or something. And your price is going to go up too, because you're going to think, oh, this is going to be worth a lot when Elon Musk, pays $10 trillion for it. And that's going to happen. So fundamentally it is just psychological. If you and I, the seller and the buyer, both agree that the thing is worth a lot, then on the market it will be worth a lot. And if we both think that it's not worth anything, then it will not be worth a lot. Which is really interesting, especially because if you connect it back, so let's try to connect it back. We're talking about capital running around and not having real investment opportunities, and as a result, like sort of inflating bubbles. So the way that happens is that in the normal course of things, usually the real investment sort of sucks up the capital, because companies who want to invest, they will be selling their shares, generating supply on the market. They in that one case, they will actually be taking net money in from investors. Like the money actually goes into the company, and then the company takes it and uses it for, say, buying a new factory. So in that sort of healthy scenario, then the investors are going to tend to be looking at the earnings that the stock generates. Like it's all based on the earnings stream. But what we have happening here is, because of capital consumption and balance, the price of assets keeps going up. That's because the market interest rate, the market discount rate is going down. So there's lots of capital looking for investments, but all of these companies, they don't want capital, because they're not willing to build factories, because the consumption does not support the building of the factory. So the companies are saying, no, we don't need capital, but the investors have all these capital that they want to invest. So as a result, they're bidding up the prices of all investments. So the P ratio of stocks is going up, real estate is going up, the rental yield is going down, bonds are going up even as interest rates go down. All of this is happening. So as this happens, what happens is that, in finance, you have the discounted cash flow model, where you're discounting the future cash flows to figure out what something is worth now. And if that discount rate goes down and down and down, if it reaches zero, then theoretically the asset's price goes to infinity. Which is not actually going to happen, but you can sort of understand it as the asset price is becoming sort of like undefined. Like, you're looking so far out into the future and you're discounting the future so little, that the entire asset price just comes unhinged. Like it's, when you're discount rate is 0 or 0.1%, then you can easily imagine that the asset price is either like 10,000, $1,000 or $10. Like those things sort of both become possibilities, and that is why the asset prices they sort of come unhinged. And when they come unhinged, then it no longer then investors who are always trying to make money through their insights. Whereas in a healthy economy, they would have been sort of projecting cash flows and saying, okay, this is a good company. It's earning a lot of money, and it's going to keep earning even more money in the future. And then they value it based off of that. When your discount rate goes down close to zero and it all becomes unhinged, that becomes no longer as successful of a strategy, and it becomes a more successful strategy to just to be in the in the asset that everybody else is rushing into, and the price is going up.
Yeah, there was one tweet I saw where some guy said, "I got an MBA in finance,
Yeah,
and just to watch meme currencies perform better than the market."
yeah,
That's
absolutely,
exactly what you're saying.
absolutely. That is that's the atmosphere. It's like, okay, I learned how to do all this fancy analysis, and apparently, and it doesn't seem to matter, at all in the market. The market is not really following that very closely at all.
And
Um,
one thing that I wanted to say was, as much as we talk about the economy, I think there's also a reason to why people are doing this beyond the economy. I think there's other problems. I think one of the
yeah,
biggest ones is housing. Like,
yeah,
if housing is going insane and now you need $50,000 to put a 5% down on a house or something, I don't know if that's realistic, but if
yeah,
people are that far away from participating in the real economy to getting something that they can invest in, they're
yeah.
going to be doing this unhealthy, unhinged economy stuff.
One of the things that I compare our current situation to, unfortunately, I would not like to compare it to this situation, but I compare it to the descriptions of, like, say, 1920 Weimar Germany. And you had some, similarities where you also had the stock market, going up and up and up, going crazy, asset prices going crazy. And people, at first they were like, they didn't think, whoa, our currency is dying. They said, whoa, we're getting rich. Like, you know, making money is easy. I just buy these crazy stuff. The German stock market, apparently, it was moving so fast that they were having trouble like keeping all the orders, processed, because I'm sure they were all doing it on paper back then. And there was this similar movement, like sort of out of the real economy, and everyone starts realizing that the way to make money in the economy is not to provide valuable labor or to provide capital into a valuable capital project. It is to, like, go, rush into this crazy expanding, virtual finance, this financial economy that's going crazy. And it is sort of, I even compare it to a very roundabout version of like Say's law. So if you're familiar or not with Say's law says that, um, there can be no that there can be no imbalance between the general supply and the general demand, because if suppliers are not getting enough sales, that they will lower the price, and so the money will become worth more. Is what Say's law says will happen. That if there's not enough demand, then we'll get deflation. The money will be worth more, and then you'll have enough demand. So Say's law was, kind of recognized as, sort of disproven by Keynes. So Keynes says, no, this doesn't happen. Sometimes you have, sort of based on the paradox of thrift, you have just demand just going down, and you do get an imbalance. But I would say that in some ways, that this, financial craziness, it is like a really, like, wonky, like distorted UBI. We're basically refusing to give everybody UBI, but we're giving everybody UBI by having the Fed print money, sending interest rates down, and having all financial assets become worth more and more. And so instead of people having like money in their hands through a UBI, which would be healthy, everybody is starting to figure out that the way to have money in your hands is to own a house, or GameStop or Doge or cryptocurrency. And if you do that, then the financial markets will send those prices up. Those will become worth more and more. And then when and then what, when you turn your $1,000 into $10,000 from Dogecoin, then you have $10,000 to spend, because otherwise you wouldn't. And so it is absolutely, and this was true in Weimar Germany also. You have the whole world learning that the way to make money again is not to provide a real service into the economy. The way to make money is to is to buy the craziest thing that you see, and let it become even more crazy. So I do sort of see that as a parallel, and I think it's interesting, and it is
Scary as hell.
scary and but fascinating,
Yeah.
and scary, and preferably, again, we want to actually put a UBI in place so that we can reverse all this, deflate the bubbles, and make the economy healthy again. But if we can't manage to do that, I do think that we may see stock prices and crypto prices just becoming even crazier, um, before potentially causing trouble with the dollar and all sorts of instability. Yeah, and
Oh,
it's
fun. Instability.
it's the type of thing that most economists would never talk about. Economists would hate to talk about this because it's very, again, the financial prices, they're fundamentally psychological. They're psychological or sort of game theory. And you don't have this clean thing where you can say, okay, if there's like 1,000 more units of demand, then the price goes up 10% or something like that. No, it's not like that at all. A lot of people, sometimes people who are skeptical about, like, say, inflation or hyperinflation risk, they'll say, well, where does it come from? And the thing about it is that it is a self-reinforcing dynamic, to the degree that um, it starts to show up, it also starts to self-reinforce. When people see prices going up, then to a large degree, if they see that continuing, a large degree, that incentivizes them to buy more, which causes the price to go up more. In the last month or so, Warren Buffett and somebody else whose name I forgot. One of the things that he mentioned was that in all of these like thousands of businesses that he owns, I don't know if it's thousands, maybe hundreds, um, the managers are all telling him that they are raising their prices and that they're finding that their customers are accepting the price increase, which is sort of interesting because again, this is a way that a lot of people are sort of like questioning the transmission mechanism. Where does the Fed printing money turn into higher prices? And it's sort of hard to pin down. And to some degree, it can be, the transmission mechanism can be psychological, to the degree that the buyer and the seller of real goods are expecting prices to go up. Then the seller may try to raise the price, and then he may find the buyer to say, yeah, I figure prices are going up, this makes sense.
It's
And
the it's the
he'll pay the
darn
higher price.
government. It's the
And
government's
he'll buy,
problem.
like Brian will probably tell you, he'll buy more because he's thinking maybe the price is going to go up more next month. I better get more this month before that happens.
I mean, I
Because
kind of expect prices to go up because I feel like the cost of labor is going up. That
yeah,
you can't you can't find as many people willing to work for poverty wages, and so
well,
if
the
the
cost
cost
of
of labors
labor,
go up,
yeah,
prices have to as well.
the cost of labor going up, I think, is relatively a good thing. I don't think that's a bad thing, because again, the cost of labor going up puts money in people's hands, and they can spend it normally, and they can generate normal businesses. activity.
Right.
It's not a different or bigger cost any more than like the price of lumber or the price of oil or the price of anything else going up. But the price of labor is special in that it puts money into the hands of consumers, whereas none of the other stuff does. So money in the hands of the consumers, that's a good thing, because to the degree that we can actually get real consumer spending to actually go up in a normal manner, um, to some degree that can start to pull a little bit of capital out of crazy sort of crazy speculative investments and back into real investments. So that's a good thing.
You can just call us the real economy. Whoa.
Yeah.
Yeah, Zach, I
I,
didn't
I,
quite follow what you meant by that. It was talking about the real economy versus the, like, I guess I wasn't quite sure what you meant by
the
that.
financial economy. So the real economy is like real factories, real production, goods and service, real labor, as opposed to like the financial economy, which is, say Bitcoin going up, $20,000 and putting 1 trillion more dollars into the hands of all the owners of Bitcoin.
But it really
That,
doesn't, right? Bitcoin
yeah,
doesn't change the amount of US dollars that are in circulation.
it doesn't change the amount of US dollars in circulation, but it does change the amount of US dollars that people have access to. And so all of those, crypto holders,
Does it
the
really
more the
though?
price, yeah,
But
it
does it
does, because there's a market for it. So they can go on the market, they can buy the dollars, and then they can use the dollars to buy whatever they want. So if you take it to the extreme and the dollars, kind of crash, then you can imagine the Bitcoin becomes very valuable. Prices might become sort of stable in Bitcoin, but nobody wants the dollars. But if the stores are still taking dollars, what people will do is like they'll, as soon as they want to buy something, they will, buy the dollars with the Bitcoin, but they'll get a whole bunch of dollars for very little Bitcoin, and then they'll use that to buy whatever they want. So if you look at the U.S. dollar, what the U.S. dollar does, that would show up as an increase in the money velocity of the U.S. dollar. So people are no longer buying it to hold it as a store of value for the next month, year, or 10 years, but they're using it as just a conduit. Like, I want to buy a car, so I want to buy cars, so I'm gonna sell a little bit of Bitcoin, get $20,000, and then buy the car right away. And then that dollar will kind of come into the buyer's hands and back out right away, and the money velocity will actually go up.
All right. Um, so, but what about the actual amount of money that's circulating, right? If the town has $100 between its members and they buy $100 worth of Bitcoin, and
Yeah.
Bitcoin goes up, they can't all sell. They can't withdraw more than $100 back into the economy, isn't that right?
Yeah, but it's okay. It's okay because it's similar to a banking system. They're never going to all be selling at the same time, anyways. It's always a very small portion of the asset holders that are buying or selling at any one day. That's true of Bitcoin. It's true of the U.S. dollar. It's true of the banking system.
Okay,
Um,
Eddie, I have a question for you.
yeah.
Um, so you said when
So,
we were talking about stocks that
yeah.
the money doesn't change. It just changes how much the buyer and seller are willing to sell at. So
Yeah. The
is
ratio is only
Bitcoin the same thing where that's
absolutely.
happening? So
Absolutely.
wouldn't be what Brian said that the amount of money is actually not changing, it's
Yeah.
just being put away, it's being saved away for later. So like when people buy into Bitcoin, they're actually taking money out of the economy, out of the real economy, right? Because the money velocity is going slower now that it's out. And then when they pull it back in, then it will cause this it could cause this inflation shock. Is that
Right.
a
So right now, like everybody is sort of, you can imagine these 10 townspeople, they're all holding on to dollars as a store of value, as their savings. So they're earning dollars, and maybe they're saving up like 10 years worth, because they want to have some savings, and then they're gonna, they're very slowly, they only spend like 1/10 of their savings, every year. So they're holding on to lots of dollars. They're spending it slowly because that is their savings. as they begin to lose faith in the dollar and gain faith in Bitcoin, then they start wanting to hold the Bitcoin instead. Now, if the economy is still running on dollars, then they will move their savings into Bitcoin, which means they'll all grab onto Bitcoin and they will all let go of the dollar. So the dollars just start circulating around. In the extreme, like in hyperinflation, in the extreme version, this becomes like a hot potato effect where as soon as you get the dollar and you figure it's going to go down tomorrow, in the extreme, like, people would get their paycheck at noon, their wife would come pick it up and run to the grocery store to spend it on groceries so that they don't have to hold it. So their holding period goes down, the velocity goes up, um, you know, if people lose faith in that asset as a store of value. Does that
Hmm.
make yeah.
Um,
Brian
yeah.
may Brian may still be skeptical.
I'm a little skeptical. I'm trying to
Yeah.
like
It's
if
not guaranteed to happen, but it can happen. It can happen. That's the
But
dynamic.
like you said, it might be more of a see, and this is where I think you're totally right on what you just said was that it's not loss of faith doesn't come from a nice, neat mathematical equation talking about how dollars don't make any sense. It's an emotional decision that's based off of
Yeah,
the feelings of a couple 100 million people.
right. But,
And
but
so,
but then the emotions also interact with the facts of reality. So people who are bullish on Bitcoin, say, and bearish on the dollar, they are looking at certain facts like, enormous government deficit, enormous trade deficit also, and the reserve currency status of the U.S. dollar is actually a double-edged sword. Like, it has been very helpful to keep the dollar up from the past until the present, but to the degree that that the U.S. may be losing that reserve currency status, then that is a large, if central banks stop saving dollars and they sell their dollars and they start moving into gold or other currencies or whatever, that's an enormous supply of dollars onto the market, and that supply of dollars will tend to have a downward pressure on the selling
see,
price.
but I just say, like, I feel like us talking about the speculative nature of the dollar changing is actually making it more likely that it would happen. Like,
Well, it's it's both. There is so you have all these participants who are trying their best to make money and not lose money by sort of predicting where the ball is going to go. And so, to a large degree, they are successful if they do predict where the ball goes. So where the ball is going, it does matter. Like, the facts do matter. But on the other hand, and this is sort of George Soros's idea of reflexivity, the market participants' actions, they also affect where the ball is going to go. So if it's sort of going that way, and then everybody's like, okay, it's going that way, then that will kind of make it go even faster. You can't realistically expect all the market participants to start acting against their own interest instead of for their own interest. That's never going to change. The only thing that can really be changed systematically, the thing that would be wise to do, is to change. If you are the U.S. government, if you're in control of the U.S. government, the smart thing would be to put out a UBI, to raise taxes so that you don't have to borrow that, and that would help a great deal. And those two things will fix almost, if you do it well enough, will fix
and build
almost.
houses.
um, you don't even have to necessarily build houses. You just have to, if you're getting the economy going and interest rates go down, that'll pop the housing bubble, and that'll be fine. And then if the economy kind of, you know dips because of that, then you can, give even more UBI, even a little bit more UBI. The
Hmm.
the If you take care of the real economy and that includes the real government finances and the a little bit the trade position of the country. The financial economy will take care of itself. Those guys, if you're sending the country and the economy in a way that is real prosperity, then some market participants, some investors will predict that correctly and they'll make money, and some will predict that poorly and they'll lose money. And that's okay. They all have money to most of them have they pretty much have money to make or lose, if they're playing the game. Yeah.
All right. Anybody else have anything they want to add, or did we cover this pretty well?
I think so. Um, I'm not convinced on a lot of things that Eddie says sometimes, but I will listen. Usually, what ends up happening is I end up listening back and thinking, like, oh, yeah, that makes sense now that I've heard it a second time. But first time I hear it, it's a little bit more difficult to.
Yeah, it's not. I want to be clear. It's not guaranteed that we go into severe inflation at all. But but we're sort of heading, I would say, a little bit in that direction more than away from that direction, and it would be better to head away from that. And the way to do that is with UBI. I think that's something that you'll hear on this channel that you probably will not hear anywhere else. Not Austrians, not MMT, not orthodox economists. None of them have figured out that the way to stop inflation, the reason you have inflationary risks is actually because of the capital consumption imbalance. And you actually have to fix that by putting money into the hands of the consumer, and also potentially taking it out of the hands of the wealthy, in order to take that risk away. If we started tomorrow, we would be perfectly fine. To the degree that I'm worried about this, I'm worried really that the political system is not going to kind of do the right thing soon enough. And so it is a tragedy of understanding, not a tragedy of inevitability. Inevitability.
I'm
Yeah.
on board with that.
Yeah.
And
I think yeah, go ahead, Brian.
I was going to say, I think it's also important to point out that UBIs will sort of negate the effects of inflation for a lot of people, right? That if we're sticking to this 2% inflation and you're getting the freedom dividend of $1,000 a month, but you can only buy $980 worth of stuff, you're still pretty far ahead. So
Yeah. Yeah. And it'll suck
UBI
capital
solves an awful lot of problems.
to the real economy. I have an analogy a little bit to what's going on right now. There was this plane crash that happened, and I forget the name, the flight number, whatever. But when they analyzed it, they figured out that what happened was that the airspeed, the airspeed monitor, the airspeed, that instrument like got stuck. So the pilots were seeing the airspeed go way down, even though the plane was not actually slowing down. And what happened is that as the pilots and the computer system apparently saw the airspeed going down, it gave out a stall warning. So it said, stall, 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 nose down. Because when you're in an airplane and you're going too slow and you're in danger of stalling, then you want to turn the airplane down to go into dive to pick up more speed. So they did that, but then the instrument was broken, so it continued to say stall, 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 nose down. So they nose down a little bit more, and it keeps going. And they're like, what the f, what the hell's going on? The computer kept warning that they're stalling. They kept nosing the plane down, and about 30 seconds later, they crashed at full speed into the ocean. So there was absolutely nothing wrong with the plane. The plane was functioning perfectly, except for the understanding that it was giving to the pilot in the model it was putting into their head was incorrect. So they thought that their plane was going too slow and they needed to nose down and pick up speed. But actually, that was the opposite, the wrong thing to do. And they unfortunately crashed their plane into the ocean, and everybody on board died. Because wrong understanding, and that is where the economy is going. You know,
What a happy, cheerful story for you to
That's what
share
you
with
get
us.
on
That
this
like
channel.
the
That's
simple
what you get
story.
on this channel. You get stories of how
there was
everybody's gonna end up dead.
probably puppy dogs on the plane too,
We'll,
right?
we'll survive this. We'll survive this one somehow. But this is sort of what maybe like the Austrian economists are going towards. Like they think that we need to take money out of the economy, but they're wrong. You need to take money out of the top and put it into the bottom. Um, but they're definitely they're holding out fiscal policy. The left is also sort of trying to put it in the wrong places because their money is also going to the top a little bit too much. But you're headed towards a situation where and then the Fed is on that one track model where they think you're either going to get inflation or you're going to get like unemployment. And we're heading a little bit towards a place where we're going to get both, and the Fed is not going to know what to do. Um, and if they handle it wrong, they don't figure out what the problem is and the way to fix it, which is to take it from the top and put it on the bottom, then they'll either get too little and have a big depression and crash, or too much and have like hyperinflation, because you're holding up the economy on these large and growing asset bubbles, and potentially you might do that until it just the whole thing just um, sort of like floats away as assets and the goods prices also go up, and the dollar crashes against everything else, and that'll take the real economy down too. So
And then you end up with dead
yes,
puppies in the ocean.
hopefully that doesn't happen. Hopefully it doesn't. Um, you know, so vote for UBI, everybody.
I think
Spread
that's
the word.
that's
Get on
that's a
American
great
radio.
place to end us, right?
Yeah,
I think,
yeah.
just the visual of if you don't do UBI, dead puppies in the ocean.
Red puppy with the ocean. Yes.
Yeah. All right.
Okay, very good. Talk to you guys later.
Thank you.
Thank you.